Imagine waking up, opening your bank app and discovering that without asking, without planning, and without exactly understanding how, several credits have been approved in your name, ready for immediate use, as if it were an unmissable opportunity, but which in reality could be a silent trap about to compromise years of financial stability. This is a scenario that's becoming increasingly common among retirees and pensioners, especially at a time when access to credit is easier than ever, fast, automatic, and apparently harmless. The problem is that what seems like help can, in practice, be the beginning of a financial cycle difficult to notice at first, but extremely heavy over time. Excess approved credit creates a false sense of security. When the retiree sees available limits, pre-approved offers, messages saying the amount is ready for withdrawal, the impression arises that this money is part income, when in reality it's a future commitment that will be charged month after month. This difference between perception and reality is exactly what transforms easy credit into a silent danger. There's no alarm, no dramatic warning, no clear moment of rupture. There's just a small deduction that starts appearing in the statement, then another, then one more, until monthly income no longer has the same strength as before. Another factor that intensifies this risk is how institutions structure credit approval for Social Security beneficiaries. Since income is considered predictable, the financial system sees this profile as low risk, which facilitates automatic approval of payroll loans, cards with high limits, and successive refinancing. In practice, this means a retiree can receive multiple offers simultaneously without necessarily having requested any of them, creating an environment where credit becomes constant, accessible, and dangerously normalized. The real danger isn't in credit itself, but in the frequency and ease with which it's offered. When access is immediate, the decision stops being strategic and becomes emotional, an unexpected expense, help for a family member, an installment purchase, or even the feeling that it's better to use it now than leave it sitting there can be enough to start a sequence of contracts that, combined, drastically reduce net income over months. And most concerning is that this process rarely happens consciously. It happens gradually, silently, and progressively. There's also a psychological aspect that needs to be understood. After retirement, many individuals seek stability, tranquility, and financial predictability. When pre-approved credit appears, this can be interpreted as an extension of the security, as if it were a resource available for emergencies. However, this interpretation ignores a crucial detail. All approved credit represents a future obligation that will reduce purchasing power over time. Thus, what seems like an immediate solution can transform into continuous financial limitation. Another element that makes the scenario even more delicate is the communication used in credit offers. Terms like approved, available, fast, and no bureaucracy are strategically positioned to convey ease and urgency, but rarely highlight with the same intensity the accumulated impact of installments on monthly income. This creates an information asymmetry where immediate benefit is emphasized, while long-term consequences remain in the background. The result is a decision based on present convenience, not future sustainability. Over time, the accumulation of small monthly deductions can generate a financial domino effect. The budget, which was previously sufficient to cover essential expenses, starts getting tighter. Then adjustments in consumption patterns emerge, silent cuts, and, in some cases, the need to resort to new credits to compensate for committed income. It's at this point that the cycle becomes dangerous, because credit stops being an exception and becomes a financial compensation mechanism, creating indirect dependence. Many retirees believe that because these are installment amounts that appear low, the impact will be minimal. However, the cumulative effect is precisely what makes excessive credit so silent. A small, isolated deduction may seem irrelevant, but several simultaneous deductions profoundly transform the monthly financial structure. What was once a safety margin becomes committed margin, reducing capacity to deal with unexpected events and increasing financial vulnerability. Another critical point is the lack of specific financial planning for the retirement phase. During active working life, income can be adjusted with overtime, promotions, or new professional opportunities. In retirement, income tends to be fixed, predictable, and limited. This means any recurring financial commitment has a proportionally greater weight. Excessive approved credit ignores this fundamental characteristic and encourages decisions that don't consider the stability necessary. in this period of life. Additionally, there's the risk of credit trivialization. When offers become frequent, constant, and automated, access to borrowed money stops seeming like a relevant decision and starts being perceived as something common, almost automatic. This trivialization reduces risk perception and increases the probability of successive contracts, often without detailed analysis of conditions, rates, and future impacts. Another silent aspect is the emotional impact of gradual income commitment. At first, deductions may seem manageable, but over time, the reduction of available income can generate anxiety, insecurity, and a feeling of loss of financial control. This emotional pressure, in turn, can lead to even more impulsive financial decisions, reinforcing the silent debt cycle. There's also external influence, especially when family members or acquaintances know there's available credit. In many cases, the retiree is seen as someone with easy access to financial resources, which can generate requests for help that, although well-intentioned, end up being financed by payroll loans. The result is a financial commitment that didn't arise from direct personal need, but from social and emotional pressures. Another relevant factor is a lack of detailed analysis of rates embedded in credit operations. The ease of contracting often reduces attention to real costs involved, such as interest, charges, and long payment terms. Even when rates seem lower compared to other modalities, the long deduction period can represent significant financial loss over years, especially when multiple contracts coexist simultaneously. Over time, excessive approved credit can affect not only the monthly budget, but also the retiree's financial autonomy. The greater the number of automatic deductions, the less flexibility to reorganize expenses, invest in quality of life, or deal with medical emergencies and family unexpected events. This loss of flexibility is one of the most silent and, at the same time, most impactful effects of progressive indebtedness. Another rarely discussed point is successive refinancing. Many institutions offer possibility of renewing contracts even before full settlement, releasing new amounts while keeping the monthly deduction active. This practice can give a sense of immediate financial relief, but in practice, it prolongs the debt period and increases the total amount paid over time, creating a cycle difficult to interrupt. In the long term, excess available credit can distort the perception of real income. The retiree starts considering the total amount received before deductions as reference, without realizing that net income, that which is actually available for use, is getting smaller. This distortion makes financial planning difficult and increases the risk of decisions incompatible with real financial capacity. Another silent element is the absence of regular financial monitoring. Without reviewing statements, contracts, and deductions periodically, many retirees only notice credit's impact when income is already significantly committed. At this stage, financial reorganization becomes more complex and requires more structured measures to recover balance. It's also important to consider that easy credit can mask structural financial problems. Instead of adjusting expenses or reorganizing priorities, quick access to credit can be used as an immediate solution for budget imbalances, postponing the need for deeper financial planning. This postponement, however, tends to amplify the problem over time. Another relevant aspect is the feeling of normality that accompanies automated credit. When approval happens without active request, the process seems institutional, legitimate, and even expected, reducing the perception that it's a financial decision with long-term consequences. This normalization is precisely what keeps the danger invisible. With the advancement of financial technology, offers have become more personalized, frequent, and targeted, further increasing exposure to credit. Messages, notifications, and constant contacts reinforce the idea that the available amount should be used, creating an environment where financial temptation is always present, even when there's no real need. By observing the scenario strategically, it becomes evident that the danger of excessive approved credit isn't in an isolated event, but in a continuous process of small decisions that, combined, completely transform financial reality. Each contract seems small, each installment seems manageable, each offer seems convenient, but the set of these choices defines the final impact. Therefore, understanding this phenomenon is essential to preserve financial stability in retirement. Credit can be a useful tool when used with planning, clear objective, and conscious analysis, but becomes significant risk when it becomes automatic, frequent, and emotionally encouraged. The real danger doesn't make noise, doesn't generate immediate alert, and doesn't appear as sudden crisis. It builds silently, month after month, deduction after deduction, until income no longer has the same capacity to sustain the tranquility that retirement should provide. And it's precisely because it's silent that this risk requires active attention, financial awareness, and strategic decisions. Because, in the end, excessive approved credit isn't just a financial facility. It's a continuous responsibility that accompanies a retiree for months or years, directly influencing their quality of life, autonomy, and financial security. Understanding this isn't alarmism. It's protection. It's the difference between using credit as a control tool or allowing it to discreetly take control of the financial future without anyone noticing until the impact is already deeply installed.